Welcome to the Deep Dive, where we cut through the noise and get straight to the market narrative. Today, we are jumping right into the Q2 2025 earnings call for Vee PowerCats Co., ticker VEEE.
And our mission for you today, well, is pretty clear. We need to figure out this disconnect. Management, that's CEO Joseph Fiscanti and CFO Michael P. Dickerson, they painted one picture.
Right, a picture of operational improvement.
Exactly. But the market reacted, let's just say, pretty negatively, almost immediately. The results came out pre-market, and that stock reaction, it really screams skepticism about what's coming next.
Yeah, skepticism is definitely the word, because, if you just look at the numbers, the operational side, it actually looks like things are turning around, especially in what's been a really tough cycle for marine companies.
It does.
So let's start with those headline figures. Revenue first came in at $4.76 million. And the big deal here, the really pivotal part, is that's up 9.9% year over year.
And that's not just any number. That YOY growth, it's a huge milestone for them operationally. It's actually the first positive year-over-year growth rate they've posted since, Q1 2023?
Wow, that long.
Yeah. So it basically ends 7 straight quarters where they were, really slogging through a downturn. Management seems to be guiding the ship out of the worst of it, operationally speaking.
Okay, so definite signs of life on the top line. Now, the bottom line, they posted a GAAP net loss of $0.87 per share, which, a loss is never good news.
No.
But the net loss itself, that narrowed quite a bit, $1.65 million. That's a massive improvement, like 63% from the $4.52 million loss they had the year before.
Yeah.
So operationally, it looks like they really focused on controlling what they could control.
They absolutely did. But, okay, here's a number that just screams disbelief from investors. They cut their loss by almost 2/3, boosted margins hugely, and the market hammers them. A 3.1% sell-off the same day the results came out. Then, the next day, boom, another 16.3% drop.
Wait, hold on. A 63% improvement in net loss, and the stock tanks almost 20% over 2 days.
Exactly. That level of punishment, it suggests investors are either thinking this revenue bump is just a blip, or they think the cost cutting is just papering over cracks, like the demand just isn't there long term.
It's a huge disconnect. The market clearly isn't questioning the execution on costs.
No, not at all. They're questioning the scale, the demand environment. And what's fascinating, digging deeper, is how much of that financial beat came from just pure internal discipline. Costs.
Okay, let's get into that. Margins.
Massive expansion. Gross margin went up 910 basis points year over year, hit 13.8%.
910 basis points. In this sector in one quarter, that's enormous.
It really is. You don't usually see that without some major price hike pass through. Management said it was down to production efficiencies, getting the product mix right, and just holding the line on pricing.
Okay, so efficiency gains paying off. What about operating expenses? OpEx.
Also dramatic. Down 52% year over year, landing at $2.33 million. Now, okay, a big piece of that was an impairment charge in the prior year that wasn't repeated.
Okay. So not quite apples to apples.
Well, even if you adjust for that, even if you normalize it, operating expenses were still down a very disciplined 27%.
27%. Okay, that's still significant. So those themes management kept hitting. Protect the balance sheet, maintain pricing discipline, align product flow with dealer demand. They actually walked the walk this quarter.
They really did. The execution on cost seems undeniable.
But the question is, can they keep cutting OPEX by 27% without eventually hurting the business, cutting muscle instead of fat?
That's always the balancing act, isn't it? But for now, the balance sheet looks healthier. They ended the quarter with $6.2 million in cash and restricted cash. That's up over $1 million just from the previous quarter.
Right, reflecting that cash management. And didn't they do a secondary offering in May?
Yep, that helped too. And that cash position, it wasn't just about playing defense, it gave them the firepower for some strategic moves. Which brings us to Bahama.
Exactly. Let's shift to those bigger operational changes. The stuff management hopes will drive future growth. First, inventory. Always a huge issue in the boat industry.
A major pain point, yeah.
They added 10 new dealer locations, which, okay, that's standard expansion. But the key thing, they said they cut field inventory way down from nearly 160 units historically.
Right, which is a lot for them.
Down to about 50 Vee units out there now.
And that's really important. They're basically reducing their reliance on dealer financing, what's called floor plan exposure, trying to avoid getting caught with too much inventory if demand stays soft. It protects those margins they worked so hard to get.
Makes sense. Aligning supply with actual demand. Okay, what else? New products?
Yep, they launched a new 22-foot BayCat model. And they specifically mentioned having the manufacturing capacity ready to ramp that up to 4 units a month.
Okay, a new model. But the really big news, the one you mentioned, was that June acquisition, Bahama Boat Works.
That's the one. That acquisition, it's a really clear signal. They're aiming higher, moving up market. Bahama is known as a premium brand. Offshore center consoles, really good reputation for craftsmanship.
So it complements the existing Twin Vee catamaran lineup, adds a different flavor.
Exactly. Adds quality, adds pedigree. But the strategy isn't just buying the fancy name.
What do you mean?
Well, Bahama's current boats are big. We're talking 35, 37, 41 footers, even a 41 GT. High price points. The plan Twin Vee laid out is to expand that lineup downward, introduce smaller Bahama models.
Ah, like bringing the brand to more people.
Precisely. They're talking 22, 24, 28, and 31-foot center consoles under the Bahama brand. The idea is to capture a broader audience, maybe younger buyers, families, people who want that Bahama quality, but in a more accessible size and price.
Interesting. And how are they going to build all this efficiently?
Good question. Management made a point of highlighting a new piece of equipment they just got delivered, a 5-axis router.
Okay, sounds technical. Why does that matter?
It means they can bring more tooling in-house. Instead of relying on outside suppliers for complex parts, they can make them themselves. That should streamline manufacturing, improve precision, cut down on lead times, and reduce costs. It helps make those margin gains more sustainable, more structural.
Okay, so internal improvements, strategic acquisition. Now let's talk tech. That seems to be another angle they're pushing. They expanded their 3D boat configurator tool online, right? Added the new BayCat and some other models to that interactive build and price thing, standard digital marketing stuff. But the really interesting play, the big swing for the fences technologically, is this new subsidiary they launched, WhizBanger.
WhizBanger, okay. What is that?
It's a wholly owned subsidiary, and they're focusing it squarely on the used boat market. Management literally called it the Carvana CarMax for boats.
Okay, bold claim. Is that just a distraction, though? I mean, building a whole new tech platform for used boats, that takes cash, it takes expertise. Aren't they maybe spreading themselves too thin when the core business needs focus? That's absolutely the risk the market sees, I think. Especially with the stock reaction we saw, it could look like a costly sideshow. But if you look at their angle, the key feature isn't just listing used boats.
What is it, then?
It's an AI-powered valuation tool they built called the Whiz Value Report. Think of it like a Carfax for boats, a detailed condition and history report.
Ah, okay, so it provides transparency for banks doing loans, insurance companies, dealers.
Exactly. It streamlines the whole transaction process for used boats. That's the immediate value proposition. But management sees it as potentially much more.
How so?
If that AI platform, that Whiz Value Report, actually takes off, if they can sell it as a service to dealers, banks, insurers, suddenly you've got a potential high-margin recurring revenue stream. Software as service, basically.
Okay, so that would change the story. VEE wouldn't just be a boat builder fighting cycles.
Right. They could pitch themselves as a marine tech company. That's the potential pivot. And it's a pivot that the current stock price seems to be completely ignoring.
But we have to keep this grounded.
Yeah.
Right? The overall marine industry is facing headwinds.
Absolutely. You look at the NMMA reports, new powerboat sales are down maybe 7% to 13% year over year. That's significant.
And interest rates are high. Inventory levels are still being worked through. Every company selling big ticket fun stuff is cautious right now.
No doubt. Twin Vee is swimming against a pretty strong current. So if you boil it down for the listener, yes, they had great operational results this quarter, impressive cost cuts, margin lift, but the market is looking at the weak industry backdrop and saying, can you actually grow? Is there enough demand? Scale is the issue.
And the stock performance really tells that story, down 52% over the last year. Meanwhile, the broader consumer discretionary sector, like the XLY ETF, that's up over 20% in the same time frame.
Yeah, they're lagging badly. The market's basically saying, show me the sustainable demand before I give you credit for cutting costs.
So what should people be watching for? What are the key catalysts near term?
You need proof the strategy is actually working. So first, watch the Bahama integration. Are dealers ordering those new, smaller models, the 22s, 24s, 28s? Is that premium brand pulling in new customers?
Okay, Bahama execution. What else?
Look at the productivity from those 10 new dealers they added. Are they actually moving boats? And then externally, you just need the overall consumer discretionary spending environment to stabilize or ideally improve. If that tide starts to turn, VEE's leaner cost structure could mean profits snap back pretty quickly. That operating leverage could be huge.
Right. Okay. That sets the stage nicely for our next segment, the part where we discuss and let's call it outrageous but plausible trade idea based on everything we've just talked about. And remember, everyone, this is not financial advice.
Okay, so the core thesis here is simple. The market is valuing VEE like it's just another boat builder stuck in a down cycle, period.
Yeah.
It's completely adjusting the operational reset, the tech potential, the premium shift.
Missing the leverage from those huge cost cuts, basically. So how do you structure a trade around that mispricing?
You bet on that narrative changing. You bet on the market eventually recognizing the marine tech angle or the premium leverage. So the idea we'd pitch is something like a long-dated call spread, maybe 18 months out or even longer, out of the money calls.
Okay, so limited risk on the downside, but captures the upside if the story changes.
Exactly. You're betting that the combination of that 52% OPEX cut and the 910 basis points of gross margin expansion, well, it creates some serious earnings power. That power just needs a little bit of revenue stability or modest growth to really kick in.
And you see two main ways that could happen.
Yeah, two paths to that potential upside swing. Path one, the Bahama strategy works. They successfully launch and sell those smaller, high-margin Bahama models, lifting the overall revenue and profit mix.
Okay, the premiumization path.
Path two, the WhizBanger tech play actually gains traction. If that AI valuation tool, the Whiz Value Report, starts generating real, scalable, high-margin SOS revenue from dealers or banks, then VEE becomes that marine tech story.
So the trade hinges on the market eventually catching up to the improved margin profile and the new strategic directions, rather than just focusing on current weak demand.
That's the essence of it. It's a bet on a narrative re-rating driven by operational leverage and strategic pivots.
It's definitely an interesting angle, a potential turnaround story where the foundation seems laid, but the market needs convincing proof.
It does. That's the Q2 story in a nutshell. They did a lot right internally, margins, costs, the Bahama deal. But that brutal post-earnings sell-off shows just how deep the market's skepticism runs right now. They still need to earn back that credibility in a tough environment.
So the final thought we leave you, the listener, with is this. Is management's impressive cost discipline and that bold move into premium boats with Bahama enough to power through these industry headwinds? Or does the company's future really depend on successfully pulling off that marine tech pivot with WhizBanger to break free from the cycles?
We'll definitely be keeping an eye on those Bahama unit sales and any news out of WhizBanger.
Absolutely. Thank you for joining us for this deep dive into the VEQ2 results. We hope this gave you a clear picture of the moving parts and the core tensions in this story right now.